Hello, I'm Lel Smits for the Finance News Network, and joining me today from CommSec is its Chief Economist, Craig James. Craig, welcome.
It's good to be here.
Craig, there appear to be some conflicting economic indicators at the moment. European debt concerns are lingering and the end of our mining boom is in question. But local house prices are recovering and US data has been encouraging. Given this all, do you believe the RBA's latest 25 basis point rate cut was appropriate?
We think the Reserve Bank probably was a little bit premature. It's not really, though, the local concerns, which is a worry for the Reserve Bank, more the global concerns. And I suppose if you were focusing on that, the Reserve Bank wants to take out a bit of insurance, knows the global economy is a little bit softer at the moment, cut interest rates. We're in a position of strength. We can be able to do that and shore up our domestic sort of environment. But I think it was probably a bit premature, but so the Reserve Bank has shown in the past that it knows what it's doing.
And where do you think we'll see rates move over the next 6 months?
Well, customarily, the Reserve Bank doesn't just do one rate cut and then sit to the sidelines. So we do think that we'll see another interest rate cut in November, and then it'll move to the sidelines. I don't think it wants to cut rates too far. If you get cash rate down to 2.5% or even lower than that, there's a long way to go to get back up to normal. And I think the Reserve Bank just wants to do a couple of rate cuts, shore up our domestic growth fundamentals, and then sit on the sidelines for a while.
Now, you mentioned normal. What does a normal rate look like to you?
Well, I think a normal cash rate, sort of is getting up probably around about the 4.5% mark. So it's somewhat below normal. The Reserve Bank believes that that's appropriate in the current circumstances. But at some point in time, rates have got to go up just as they've come down.
And Craig, what indicators will you be paying the most attention to ahead of the next and last RBA board meeting of the year?
Well, I think the housing indicators are really important at the moment. What we do know is that home prices are rising. We do know that there's more activity in the market. There's more building starting to occur. And if that's showing a degree of momentum, I think the Reserve Bank can be a little bit more comfortable about the situation, because if there's a slowdown in the mining sector, slowdown globally, but if there's a pickup locally, particularly in terms of the housing market, it has so many knock-on effects, so many multiplier effects through the economy. So I think the housing indicators are worth a focus, and then probably the retail spending as well, to see whether consumers are getting their mojos back, we're getting their confidence levels back.
We've also just had a very mixed bag of Australia's labour figures. Job ads are down. Australia's unemployment rate has hit a 2.5-year high of 5.4%, but Australia's economy added jobs last month. What's your assessment of Australia's jobs market?
Well, I think employers are cautious. They're looking overseas, they're worried about what they see overseas. A little bit cautious about taking staff on at the moment. So they will take on staff if they need to, but most of them are just sitting on their hands waiting for things to improve. We don't think that the unemployment rate is going to rise too much. Perhaps so it'll get to a peak of 5.5%. When you think about it, 5.5%, a peak for unemployment, that's not a bad outcome.
As mentioned, Australian miners can't escape speculation that the boom times are over. Do you believe the mining investment boom has peaked?
Well, we're getting towards the peak of the investment phase. So the price phase of the boom, well, that's peaked. And that's to be expected. We had demand significantly strong in China. Our producers were racing to catch up. Well, they're catching up now, and as a result, prices are coming off. But still, the ongoing demand from China is going to be huge, and we have to invest in new projects to be able to meet that demand, and that's what we're doing at the moment.
The stagnant housing market has also been cited as a reason by the RBA for the latest rate cuts. Do you believe the cuts will be enough to revive the property market?
Well, certainly interest rates are low enough. There's no real problem in terms of interest rates, and if we have another interest rate cut, so it's just going to make housing even more affordable. The major problem has been confidence. The fact that Gen Y haven't had confidence to go out there and buy a home. People haven't had confidence to buy investment properties. Developers haven't had confidence to go ahead. But I think that's starting to change.
Finally, Craig, the S&P ASX 200 index recently hit a 15-month high. Where do you believe the market will move over the next year, and what will be its biggest drivers?
As we get into 2013, people are going to start to put their money to work again. So we're looking at the share market probably not changing too much by the end of the year, 4,500, 4,550, those sorts of levels. But we're looking at 4,650 by June of next year and 4,800 by December of next year. So I think people will get confidence over time. They'll have to put their money to work, and they will be putting some of that money to work in the share market as well as the property market. I think both those areas are going to be competing for available funds over 2013.
Craig James, thank you for the outlook.
Not a problem at all.